You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Welcome back to this week's edition of the Systematic Investor Series with Robert Carver and me, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. For those of you who are regular listeners, our conversations are intended to keep you focused and inspired to continue your rules-based investing journey. And if you're new to the show, we hope that today's episode will trigger your curiosity to check out the back catalog and listen to the past episodes that you may have missed. Like the 2 solo episodes I did over the holidays, where I went into a lot of details in terms of how you think or can think about designing your trend following program and what that would have meant in terms of performance in the last 25 years. As you may know, the aim of the podcast is to democratize the hedge fund, CTA, or quant investment world, whatever you prefer to call it. And if you want to be a part of this journey, what we ask of you is that if you can comment, if you can share these episodes, if you can rate and review them in iTunes, we greatly appreciate it. And this way we can see that you get some value from our time and dedication each week to create these episodes. And as long as that continues, we will, of course, continue to make them. And by the way, it's not so much whether or not you have a big following and therefore whether or not that your share matters or not. It doesn't really matter at all. In fact, even if you have a small following, because of your share, and whether it's on your feed or whether it's on a page, it tells Facebook, Twitter, Google, iTunes, or YouTube that this is something that might interest other people based on the number of people sharing it. So this is how you can let us know that the topics we're discussing, the content we're delivering, was worth your time. So with all that said, Rob, great to be back with you this week. Hope you're doing well. How are things where you are in the UK?
Happy New Year, Niels. Good to be back. We've just entered our 3rd lockdown. Wow. Yeah. So, and unlike the 2nd lockdown, we have homeschooling. So the children are not at school, but they are learning from home. So our broadband capacity during the week is being pushed to its absolute limit by, trying to get hold of...
Time to get that gigabit speed into your house, Rob.
I'm not looking forward to, in a few weeks' time, I'm going to start doing my own teaching, university lecturing. So I'm going to be saying, like, come on, guys, I need some of this capacity, please.
Yeah. Talk about a scarce resource, right?
Yeah.
It's not just Bitcoin nowadays, where the FOMO is, it's bandwidth.
Yeah, definitely.
Now, just as a quick market wrap, it's going to be pretty short. I mean, of course, there were some major political events during this week. The Georgia senator election that surprisingly resulted, I guess you could say, in a Senate controlled now by the Democratic Party, and a shocking riot, really, in Washington during the certification of the presidential election. Just a few of things that I think most people have noticed. Equity markets, funny enough, seem to anticipate and focus on the increased monetary stimulus package by the Biden administration rather than the uncertainty. However, the same election results seem to have caused some concern to bondholders, at least, where we saw a healthy sell-off, I think, in U.S. fixed income markets this week. But I want to really go back to you, Rob. Tell us how the year 2020 ended up for you.
Yeah, so 2020 actually was, if you've been listening to me on the podcast as I've been doing my guest appearances over the last 12 months, the theme's been, generally speaking, I did pretty well in January and February, and I've kind of gone sideways since then, up a bit, down a bit. So the end of the year actually was a pretty good performance, I'd say, of up 16.6%. So I'd say that's kind of an average year for me. There's been a couple of years when I've been basically flat or down slightly, and there's been some years when I've done a lot better than that. In terms of markets, best performing market was Palladium, interestingly, but also some bond markets up there, Eurodollar, BTPs. And then worst performing market for me actually was the European VIX, the V stocks. So yeah, quite a kind of hard to see any patterns in the figures for the year, really, to be honest. If I look at asset classes, the V stocks brought down my performance in vol to be actually the vol sector, which is VIX and V stocks for me, was my only losing asset class. all the other sectors I actually made money, and metals and agriculturals were the best. So really hard to see much of a pattern there, to be honest. It's definitely been a mixed year if you look at the indices, and if you look at the performance on a month by month basis. I just thought I'd quickly look at December, since it's been about a month since I last spoke to you guys. So in December I was up 4.2%, and I think actually for a lot of CTAs December was a good month. So I was kind of in the same sort of category as people there. And then for the year so far, actually, as you say, US fixed income sold off, and my worst markets in the year to date I can see are Eurodollar and US 10 years. But I have eked out a small profit in the year to date so far of just up about 1.2%. So good start to the year, but obviously we can't really say much from just a few days of performance.
Unfortunately, we can't annualize 1 week's performance, I'm afraid, but
it
would have been nice. If only. Okay. I know we're going to talk more about 2020 in a second, but just on my side, I think for 2021, I'm going to change a little bit about how I talk about performance. I mean, I'll continue to briefly put it into perspective as to how we experienced the ongoing performance at Dunn. But I think the more detailed information will be based on my own trend-following model portfolio that I went into great details about in the holiday special episodes. So if you missed those two or need a refresher, I suggest you go back and listen to those. So at Dunn, to finish the year, we had our best month actually in December. Still finished the year pretty flat, frankly, but it was the best month in December. And for our volatility strategy, that was a quiet month, a little bit down December, but we had a very, very strong year in our volatility strategy. This week, beginning of 2021, it's been pretty quiet on both strategies. They're both up a little bit, but really not much to talk about. For my own trend following model portfolio, as I mentioned, I think I was recording on the 31st of December, so we didn't have the final numbers. I think the final number for last year came in at 34% thereabouts. And of course, I don't charge fees to the model portfolio, so there's no performance fee in those.
That's a pity. It's a good performance.
Yeah, exactly. But so this is kind of the raw number per se. But this week actually, it's also had a pretty good start to the year. It's up about 3.5%. So for the month, and I talked about the three groups of models that I operate, so I'm not going to go into all of that. People can quickly find that out from the episodes. But in terms of the performance, all three groups of models did deliver a positive start to the year, although Group 2 models, which are, as a quick refresher, it's the models that try to mimic the behavior of discretionary traders, and they actually had the best start to the year. That's also where I have a long bias, and not surprising, a lot of markets are going up at the moment. In terms of sector attributions, equities did best, followed by base metals, and the laggers this week were precious metals and currencies. And if we drill down to single markets, the DAX performed the best, followed by copper. And the two worst markets, not surprising, were gold and silver, with their sell-off this week. And in terms of trading activity this week, I did actually have one of the models that tried to go long in gold very early in the week, but that got stopped out yesterday. And then the system also tried to go short some 10-year US notes, actually. And this, of course, is happening in the Group 3, so the fast reacting models. And then also during the week, the model or the program as a whole added a little bit of long sugar early in the week. So that's really what happened. Otherwise, not a lot of trading activity in the strategy. Now, before we move on to some of the questions that came in from Michael, Bruno, Kyle, and Craig, I wanted to ask you about kind of a tweet that you shared with me showing kind of the top and bottom 20 hedge fund managers, which had quite a lot of dispersion in returns this year. So perhaps we can use that as a springboard to talk a little bit about 2020 as a whole. What have stood out to you, Rob?
Yeah, so it's the list of the top roughly 25 and bottom 25. So you're obviously going to see huge dispersion because you're looking at the extreme ends of the spectrum, right? But what's interesting is there are a lot of funds in there, of course, you don't recognize. They're probably smaller funds, lower AUM, don't have probably quite high vol targets. So you'd expect to see them in the extremes of the distribution. But there's also some big names in there. So on the long side, for example, Marshall Wace had a fund that did very well. Roy Niederhofer had a form that did very well. And there's a fund run by a guy called Crispin Odey, who's quite a kind of well-known UK hedge fund manager. And that also was right up there. But at the worst end of the spectrum, and so these are funds that have lost 14% or more in the last 12 months. Although I should say that this tweet is a bit misleading, because if you look closely, it does have the dates when the performance is up to, and some of them are the end of November. So there's a bit of extra performance in there. One of them actually is till the end of August. So I don't know whether the fund then closed down. So, we can't necessarily compare apples with oranges here, but still, it's interesting to look at the figures. So down 16% was Systematica, which is a Swiss, well-known Swiss trend following fund that was spun out of Blue Crest, of course. It used to be known as Blue Trend. You've got our friends at Winton.
Yeah, can I just interrupt you there? It's not their trend following fund that their trend following fund actually did well last year.
It's a macro RV fund. Yes.
Yeah,
yes.
It's the relative value fund. So just to be clear on that.
Good to correct that. So Winton's diversified futures fund, which I'm pretty sure is a trend following fund, was down 17.5%, and we'll talk about that probably in some detail. And there's another Winton fund that was down 23%. And interestingly, another fund run by Crispin Odey was down 29%. So he had actually huge dispersion just looking at his own book, which was quite interesting. And then we had Renaissance's diversified alpha fund down 33%. So this, of course, we talked about this before. This is the fund that's open to outside investors, not the Medallion fund that's closed. The Medallion fund, of course, performance is not publicly published, but it's generally speaking done better than their public funds. And we've talked about the kind of potential conflict of interest here at some length beforehand. So some big names there. And you can do two things with these. So what the financial press likes to do is, of course, they have to write stories. And there was an article in Bloomberg saying, discretionary traders beat quant traders this year. It's a disaster for the likes of Renaissance and things like that. And it's all because of the pandemic, and these quant funds don't know how to deal with pandemics. And of course, that's very misleading, because you're just cherry picking a few examples there. Now, I'm not going to deny that the kind of market activity here has been difficult for certain kinds of quant funds. But of course, it's probably been quite difficult for certain kinds of human traders as well. So, for example, if you're a discretionary equities manager with a value bias, for the first 9-10 months of the year, you were just getting absolutely hammered, as all of these momentum stocks, these growth tech stocks, just completely outperformed and bashed your value stocks completely down. And it was only really when the vaccine news came out that we saw a reversal of that, and since then value has kind of caught up. So it's not just a discretionary quant story. And actually, if you look at the indices, they show a much more nuanced picture in terms of performance. So, for example, the SocGen CTA index was up quite strongly in December, which is something I alluded to earlier, and finished the year as a whole up as well. And although there have been some trend-following funds like Winton, which I think potentially is a bit of an outlier, we'll talk about in a second, but there's also been trend-following funds that did well last year. And I mean, your trend-following models made money last year. My trend-following models made money last year. Systematica, as you've already mentioned, did well last year in that particular segment. So it's very nice to hang this simple story of quant versus humans, because it's a nice, easy thing to write about. But there's a lot of dispersion, even within the same manager as we saw, but also amongst the different styles there.
Yeah, no, absolutely. I mean, I did briefly look at the Bloomberg article that you shared with me, and of course, they are trying to make this point that some of the discretionary stock picking strategies did better than the quant strategies, which certainly has not been the case in the last few years. And I imagine personally that the big advantage that some of these non-systematic managers did have in 2020 was the ability to anticipate the outcome of certain things, like the central bank interventions, like the pandemic, frankly, to begin with. And certainly in the recovery phase, really load up on stocks, and in particular on the technology stocks, and essentially go against the trends that we were seeing back in late March of last year. And that's always been an interesting thing, I think, discretionary versus quant, this thing about anticipation, because if you're really good at it, of course, you're going to pick turning points much better than we are. But, if you're not so consistent at picking them, then you're going to end up in trouble. The other thing that I think obviously stood out in terms of the quote-unquote perceived disappointment by firms, as you mentioned, Renaissance Technologies and maybe Bridgewater we can throw into that. Although I will say that with Bridgewater, their all-weather portfolio did actually pretty well last year. And I know that many people will judge a firm that struggles during a period of time and to be quick to conclude that their approach has stopped working. We know that from trend following. It comes up all the time. But I really think that you have to be careful with this. I don't think you can have an investment approach that works all the time. And in our world, we know that every single design choice that we make will have, an impact on performance, which means that sometimes our strategies will do better than the average, and sometimes it's going to do a little bit worse. And as long as I know, or you could say as long as the manager knows why that outperformance or underperformance is occurring, and you're still happy with those choices, you should stick with your strategy. And you mentioned it yourself. I mean, I think one of the examples of this really is Winton, and where David Harding made a very deliberate decision to shift his risk allocation away from trend following. And even if this has meant that they have underperformed in 2020, it doesn't really mean that their models have stopped working, in my opinion. And who knows? I mean, it still may be a good decision for them in the long run. The challenge, though, that we all face when we make a big decision like that is that it can come with huge costs in terms of changes in our AUM when a firm starts to make these decisions. But I'm sure you have some views on this as well, Rob.
Yeah, I mean, it's interesting because, when I was working at AHL, there was a constant pressure in that we wanted to diversify the models, the sources of return, because we wanted better absolute performance. Because from our perspective, in terms of, we were incentivized by performance fees, of course. Our incentive was to produce the best absolute performance every year. And if you have a strategy that relies on a very narrow set of sort of return factors, return streams, alternative beta, whatever you want to call it, then you're inevitably going to do worse in the long run than something that's more diversified. So that, a portfolio that's got a bit of carry and a bit of momentum and a bit of mean reversion will almost certainly over the long run outperform a portfolio that's purely focused on momentum. But the problem, of course, is that our clients didn't want that. They were like, we are buying you for the momentum part of our portfolio. And if we have another manager that we'll use for the convergence trades, if you like, the carry type trades, the RV types trades. We want you to stick to the knitting. We think, A, this is what you're good at. And B, we're relying on you to fulfill this role in our portfolio. So that makes it very difficult. And even if the manager themselves would like to diversify into doing different things, it makes it quite difficult if there's a pushback from their clients. So one thing you can try, of course, is to try and, raise new money effectively and say, right, well, we're still going to carry on doing this, but we're also going to launch this new fund, perhaps, that's more focused on a different kind of strategy or a different set of strategies, have different mandate, and hopefully attract either, money from your existing clients who say, well, we like these guys, we trust them. They seem to be good at quant generally. Okay, they've only had a track record of momentum, but we trust them well enough to give them more money to put into this new fund that's still quant focused, still systematic, but has got a wider remit. Or maybe you'll attract new money from people who have never invested with you before, but are looking for that particular kind of fund. Where it's difficult is where you kind of try and shift your entire sort of main fund from one place to another, and you can only do that very gradually. And there's a couple of risks with that. One risk, as you say, is that people won't like it. They will, for the reasons I said, they'll be like, no, we want you to stick to this. And even if you're not explicit about it, which is potentially very dangerous, a good client will say, we've noticed your correlation with your peers has been going down. What are you doing differently? And there'll be concern there. And the second issue is if your timing is bad and you diversify at the moment when these other things that you're adding to your portfolio underperform. And that appears to be what happened last year with Winton. It looks like they underperform momentum very strongly because they had a lot of other stuff in their portfolio that did particularly badly. Your sophisticated clients won't like the fact that you're changing your mandate, but all your clients will hate the fact that you've lost money or certainly massively underperformed the benchmark. And, Winton sadly are seeing that in a loss to their AUM at the moment.
I actually think that's a good point, and I really wonder if you could say that it's not necessarily that they made a bad decision, but their timing was bad
or unlucky.
Yeah, unlucky. Yeah, of course. Yeah. So I think that's a really valid point. The other thing that springs to mind when you say what you say is that we hear that a lot, that, the people say, well, let me put it this way. When trend followers are doing well, we hear a lot of people saying, yeah, we're buying pure trend because we love pure trend and that's what we want you to do. And that's the role you fulfill in the portfolio. The problem with that is that often when trend following goes through one of their bad spells, which it does, and which we've been through the last, say, 5 years or so, it doesn't hold and they will redeem. They won't want that pure trend anymore. That's the challenge the manager has, that we almost know that if we stick to our knitting, it's going to be bad for business. We almost know that. And so it's a big challenge. And very few of us, I would say, have done it and just stuck with it, trying to mitigate the weakness of trend following, because there are weaknesses, by just becoming better at it. And all I can say is at our shop, I mean, it's been a 47-year journey so far, and we're still trying to improve. So it's really not that simple to do. And you and I know, Rob, there's a few other managers out there that are well known for their pure trend stuff, and they're highly volatile and have had a difficult few years now, and had a pretty good year actually this year because of December, right? Very lumpy. All the returns came in December and all of that. So this is tricky. Now, if I can just expand on one thing about that, and that is when I look at our returns in 2020, I can't help notice that the two best months of 2020 were March and December. And these 2 months could not have been any more different, really. In March, you had a massive crisis in the market, and in December, it was all full of optimism and celebrating the vaccine being rolling out. And to me, and I want people to challenge me, I think, if they disagree. To me, that goes to show the robustness of trend following. The fact that it can handle two so different environments, even within a 9-month period. Now, of course, I'm not blind to the fact that the transition period between those two environments were more challenging. But I do still think that it just tells you all you need to know as to why trend following continues to work.
Yeah, I think it's interesting because a lot of people use correlation as a measure of whether something is undiversified or diversified to the rest of their portfolio. And obviously correlation is a very simple linear measure. And you can have two assets that basically have a zero correlation with, your long only sort of 60-40 portfolio. But actually, when you drill down to individual months, you see a very different pattern. So if you look at something like, a leveraged long-short equity portfolio, overall, perhaps, yes, it has a low or zero correlation with the market, but it tends to do very badly in months when risk assets generally sell off. There's a very clear pattern there, like, for example, March 2020, September, October 2008. There's a very clear non-linear pattern there, crisis, sell-off, crisis, sell-off. But trend following is much more, it does, again, probably has roughly a zero correlation with your classic 60-40 portfolio, but there's less of that clear pattern. There's perhaps a slight tendency for it to do well in crises, to be this kind of tail hedge insurance type asset, but it's not really a clear enough pattern for you to legitimately sell it and say, yeah, this is a tail hedge to your main portfolio. It's something that's undiversified, not just in a linear way in the sense it's got zero correlation, but also actually in the fact that when your long only portfolios are doing badly, sometimes it will do well, sometimes it will do badly. Maybe on average it does a little bit better. There's a bit of a tail hedge property there, but not very noticeable. But it's not this very clear kind of, yes, this so-called uncorrelated asset actually is secretly, underneath the hood, really a risk asset because it does very badly in crisis months.
Yeah, I mean, We've talked about this whole concept of crisis alpha many times, of course, over the years. And it's a very, how should I say, it's a term that can be held on to by some. We're saying, yeah, this is it makes sense to me. The problem is that it's the definition of a crisis that really determines whether it works or not. And what we know from history, there are a couple of things that I actually think is really interesting about crises in general. And I think 2020 showed that as well. First of all, you could just talk about time frame and speed, right? So we know that the short-term managers did relatively better, certainly in February. I don't know about March, but certainly in February, they did better. And by the way, I should say that I am trying to get a very large short-term manager to come and challenge our views, because we're all a little bit biased towards trend following here, or longer-term trend following. So let's see if that all works out for our lineup in 2020. But that being said, and by the way, we talked, Jerry and Moritz and I talked about this just before the year ended, that it was interesting to see that trend followers measured by the SocGen Trend Index had been lagging the performance of short-term managers all year. But at the end of the year, actually, it was the trend followers who ended up doing the best. So this is something that people just need to understand, that they serve a different role. And during a crisis period as a whole, they will do better or worse depending on where we are in the crisis. And by the way, I think the probability is higher that trend followers usually, when we talk about crisis, we really mean equity crisis. But I think the probability of trend followers to do well in the initial part of a equity crisis is probably quite low, simply because we tend to be on the wrong side of the equity part of the portfolio. And if I look at our attributions in the last few years in terms of sectors, equities, I think actually is pretty much the worst sector, because we've had too many of these really sharp sell-offs at a point where you're coming from an all-time high, and so you're fully loaded up on equity. So that's normal. And this is why we diversify, because what other managers that we know well in this industry, when I look at some of their studies, and I see it on our side as well, the most consistent sector during crisis is actually things like commodities. They tend to do well. And this year as well, commodities actually did well for trend followers. And they certainly did well during the crisis, because we had energies where we could make use of the short side of that trade, and so on and so forth. So that's one point I would say. So you're right. I mean, people really shouldn't buy CTAs or trend followers for tail hedge protection. Then I would say it's probably much better to look into some kind of volatility strategy, which is also why we on our side now have that as a standalone product, simply because it can react much faster. It can be more specifically exploiting expansion of volatility in terms of short-term expansion of volatility than a trend following program can. But again, you end up with the same challenge as an investor that you talked about, Rob, and that is, okay, so if I choose the short volatility guys, I'm going to make money most of the time, but I'm going to partly blow up, once in a while. But if I choose the long volatility, which is going to help me during a crisis, I'm going to bleed a lot in between the crisis, and I'm most likely going to sell that investment just before I need it, almost like a trend following strategy. So I think the challenge to investors, and I actually think that Richard Brennan down in Australia and his crew does a really good job of showing how, if you combine, and they, I think, use like 10 of the best CTAs, they put them in a portfolio, of course, with the benefit of hindsight, because it's based on historical returns. But if you just show how even a combination of trend followers, how they can blend well together and create very attractive, not just overall returns, but risk-adjusted returns, I think it's very hard to ignore the value of what we can add to a portfolio.
Yeah. Just one thing before we finish 2020, I think I should say, I've actually got a friend who works at Systematica, so to correct for my mistake earlier, I will point out, I've just checked, and the Systematica Global Trend A fund was up about 2.5% last year. So, yeah.
Yeah, and I think Blue Trend did even better, actually.
Yeah.
Yeah. So, yeah, no, absolutely. I mean, trend followers in general, it wasn't a bad year. I would say between the bigger managers, it was either flat to plus 10% between most bigger managers with more or less the same level of volatility, right? Then you have some people with high vol, they did a bit better, and so on and so forth. There were a few trend followers that lost more than 5%, but not many really. And again, that doesn't really tell you much about, is it working, is it not working? It just tells you because, and I haven't got the final data for 2020 yet, but when I was looking at it the last time frame or look back period, as we call it, was incredibly important last year because there were many time frames that didn't work, but there were a few that worked really well. So if you were inside those time frames, congratulations, you got it right. The other thing that were quite important last year was really markets, because there were a few of the quote unquote smaller markets that had exceptional trends. I know Moritz always talked about iron ore, for example, and stuff like that, which we don't trade. We didn't benefit from that. But there were a few markets that did really well. Of course, Bitcoin, those managers who trade Bitcoin in their trend following portfolio would have done maybe not exceptionally well because there were also a sell-off during March, but probably would have done okay. So it was just another year, and another year that causes difference in performance depending on the choices you've made. So I want to move on to the next point that you also shared with me. And I did actually read your blog post because I thought it was very interesting. And that's about, risk and maximum drawdown, how that all fits together. I thought it was a very interesting post, and I want you to talk about it. I may comment on it later on, but there was one thing that I just wanted to challenge you on a little bit.
Good.
Because I saw a sentence, and maybe you didn't mean it the way I read it, but I saw a sentence where you said, a 10% vol gives you an expected drawdown of 23%, where a 20% vol pushes you to 46. That's fine. I agree with that. And then you write, clearly, the higher your Sharpe ratio, the less likely the chance of a large drawdown. And I was thinking, can we actually make that conclusion? Because if you think about people like long-term capital, they would have had a massive Sharpe ratio. If you think about short vol strategies in general, they have very high Sharpe ratios, but it doesn't mean they can't have big drawdowns.
That's true. So here I kind of dig out of my briefcase the standard caveat for any kind of research, which is that it depends on the kind of model of returns that you're using.
Right.
So actually, I did all of that analysis using a standard kind of assuming that returns were Gaussian normal, so that they had no skew or kurtosis compared to a Gaussian normal distribution.
Okay.
So clearly, if your distribution is sort of well behaved and normal, then the higher expectation of making money, the higher your Sharpe ratio is, the less likely it is that you will have a sustained period when you're losing money that will lead to a large drawdown. Now, of course, that assumption does not hold true for your LTCMs or your kind of classic short vol managers. For them, their return sequence is very much making small gains, and then having sharp losses. And those sharp losses will produce the worst drawdown loss. The worst drawdown for a manager with a Gaussian return, or indeed for a trend follower with a positive skew, is more likely to be caused by a series of small losses compounding, basically just a sequence of bad luck, effectively. And in that case, it's true that the higher your Sharpe ratio is, the less likely you'll see a bad drawdown. And it just is an emphasis of the fact that Sharpe ratio is not a good measure of performance when returns are not symmetric, when returns are not Gaussian, because it does assume that you can divide return by standard deviation, and standard deviation is a symmetric measure of risk. And of course, that's inappropriate. Now, interestingly, I did actually have at my disposal a function that would produce for me returns that were skewed. So I could actually simulate something a bit like an LCCM and see what effect that had on the drawdown statistics. Now, the hard part for that is knowing what number to put in for the skew. How big should that negative skew be to be realistic, to represent what a short vol manager can actually produce? Now, for skew that wasn't too big, in either direction, that actually did not have too much effect on what the worst drawdown looked like. It did actually change the pattern of the drawdowns overall, but I was looking purely just at the worst drawdown. So actually, unless your skew is quite negative, your average drawdown will actually be smaller if you've got a negative skewed strategy, which sounds a bit weird, but basically if you've got a negative skewed strategy, your pattern of returns means you're going to get a sharp loss. That'll be your worst drawdown, but then you'll recover from it quickly and make lots of small gains and be out again. Whereas if you've got positive skew, you're more likely to bleed money for a long time and have a sustained worst drawdown, which you then get out of course, eventually. So that maybe is slightly counterintuitive. Now, the important point is that you can't really go from this sort of theoretical abstract world of essentially random bootstrap returns using some underlying distribution to the real world of LTCM and say you can necessarily draw exact conclusions from that, because you have issues like the fact that really using a relatively simple model, you can never really get close to how horrific the sort of final distribution of an LTCM strategy was. The outliers that you see there, you just can't get them. They just don't appear, and that's because in the real world, you with a sort of relative value strategy like LTCM was running with massive leverage, you have issues of liquidity, you have margin calls, you have the fact that the whole market knows you've got this trade on and is going to be pushing the marks away from you the whole time, and that all produces things that shouldn't happen, which is that you get these massive negative returns that just are complete. The distribution of returns for LTCM is actually two distributions, right? You've got the distribution for the first few years they were trading, which is all the way over here, with a very high mean, a very high Sharpe ratio, actually looks quite Gaussian, quite normal. And then you've got the last few weeks, which is all the way over here on the left-hand side of the distribution. And it's very, very hard to, using the kind of technique I'm using, which is random returns off a fixed distribution, it's very hard to produce that kind of pattern. There's a general lesson here, which is don't just look at Sharpe ratio, and also look at your skew and decide if that's appropriate. If you're positive skewed, then Sharpe ratio actually, if anything, is going to be a little bit conservative, because you're actually doing a little bit better than the Sharpe ratio suggests, because you did standard deviations measuring also the big gains you make as a positive skewed manager when things are going well. Whereas if you're a negative skewed manager, then using Sharpe ratio is far too optimistic. And you shouldn't say, oh, well, Rob says my Sharpe ratio is 2, therefore my maximum drawdown is 5%, therefore everything's good. That's clearly almost certainly inappropriate.
Yeah. What I liked about your article, and generally, of course, I like what you write. I like the fact that you touched on this thing about, kind of average risk, which you could say Sharpe ratio gives you an idea of average risk, but then the more sort of extreme risk, which is maximum drawdown to some extent. And what I think is interesting, and you came at this article in a different way that I think about it, but I think a lot about what is the real risk to investors when I think about the journey they go through with us as a manager. And what it really is, it is the depth of the drawdowns we have, but also how long they are. More so, I think, than the month-by-month volatility, up 3%, down 3%. I don't know that they really worry about that too much. But once you get into this drawdown, so if you think about it, and my levels of quant compared to yours is much lower, so I may butcher this a little bit. So please,
we both bow
be
down
gentle.
to Moritz, of course. So
right, be gentle. So, but what I think the whole point is that most risk metrics that are being used, and let's just say that Sharpe ratio is perhaps the most widely used risk metrics. It doesn't tell you about the path of the return, meaning you can have 3 different strategies, for example, with the same Sharpe ratio, but they look completely different. One of them could be relatively, stable, a little bit volatile, and the other one, maybe a little bit more drawdown. And then if you order your returns in the most extreme case, where you take all the losses first, you're going to see an underwater curve that makes you puke, to say it as it is, because it's going to look like you're simply having all these massive losses and then it all recovers at the very end. But in a Sharpe ratio world, it will look the same. So I came across a little while ago And I know I reminded myself, I actually asked you about it because I was struggling with my Excel skills. And I think you actually helped me out a little bit on that as well. So, but I came across something in a book I read called the Ulcer Index, right? And when I saw that, I thought, sounds interesting, because if there's something drawdowns can give you, really is an ulcer. That's what we really worry about. So I looked into that a little bit. And the ulcer index in itself is somewhat interesting because it does look at your drawdowns, the depth of them. It also looks at how long they last. So that's kind of your first, and I'm not going to go into all the details because people can read up this in the literature and all of that stuff. But that was my first observation. I thought that makes sense in my world, at least. That's what I think my clients are worried about. Then you can change the formula a little bit and make it into something called the Ulcer Performance Index, which actually is kind of a ratio of I think it's a ratio of kind of gain versus pain in another way. I know Jack Swager coined the gain to pain ratio, but this is different. But it's kind of the same. How good is your strategy compared to how bad it's going to feel to be in it. So I think the Ulcer Performance Index is also interesting. But then I think this is where it becomes really interesting, because if there's one thing that we know of, and I alluded to it a little bit in terms of, long-term capital, we have Bernie Madoff, we have other strategies. I'm not going to mention the names because where you look at them as, oh yeah, that's a safe manager, and then suddenly they have like a really outsized performance year to the downside. But then they start, you can then take it further and you can start looking at, kind of the conditional drawdown of the strategy, a little bit like VAR, but only looking at the downside. And what that tells you is, okay, so here you have, say, with a 95% confidence level, this is what you should expect. So let's just say a CTA has, a conditional value drawdown is at, or drawdown, a conditional drawdown of, say, 40%. But then they may still go beyond that, of course, because this is just 95%. So they might still go to, say, 50% drawdown. And so when you start looking at that, you could kind of calculate more what you could say is a more extreme level of drawdown. And where I caught up on this, it was called a kind of a pitfall indicator. And I think that's another thing that is interesting, and that is, what should you fear, frankly, outsized what would be expected. And you can then put that ratio into, or you could put that number into, say, in the context of the volatility of the strategy. So clearly, if you have a really bad, drawdown, but normally you're only like a 2% volatility or 2% annualized volatility, that's clearly worse than, say, a CTA that loses 50% but has a 30% annualized volatility. So it gives you an idea of the danger somehow. And then you can put all of that into further context by calculating something that is called the Serenity Ratio.
These are all great names, aren't they?
It's a great name, actually. Yeah. It is a great name. And so first you need the kind of the penalized risk, which is the average risk, the Ulcer Index, times this pitfall indicator, the extreme risk. And once you have that, you simply take the return of the strategy and you divide that by the penalized risk. Once you have that, that's kind of your Serenity. And Serenity, to me, I wish it was more widely known, because at least in the way I look at it, if you calculate the Serenity Ratio on different types of strategies, what you find is, and this is something that's been articulated in different ways historically, at least I've tried to, that is, you actually get a much better feel for the true risk in the strategy. And when you do that, it's interesting to see that something like global macro and even systematic trend following has quite high Serenity Ratios, because what it really means is that there are very few surprises. The risk you see, and this is why we look more risky because we realize our risk and our volatility every single day. Unlike other strategies where it suddenly shows up and you're out. And so I really would like people to think differently about risk metrics and how they value a strategy. And I would love for them to go away from the Sharpe and to go into things like Ulcer, Serenity, Pitfall. I think it makes a lot more sense, frankly. I butchered probably some of this, and people can read up on it, but it's not necessarily super easy to calculate. I had a guy that I work with to help me do it on a daily basis to get it accurately, because that's what you really need. Monthly is not really accurate enough. But it's I think it's super interesting, and I think we could learn a lot from looking at not just different trend followers, but also different strategies in total, by broadening out the standard risk metrics that we use.
Yeah, so just quickly, and perhaps just a sort of abstract summary, I think for me there are three things you need in a good risk measure. The first thing is it should relate to your own experience of what you think risk is and how it relates to you. So you're right, a lot of investors look at drawdowns, and whereas a lot of the conventional risk measures don't care about drawdowns. My aim in writing the blog piece was to try and take two kinds of risk measure and sort of give an idea of how they relate to each other. So if to say, look, if you do have this kind of Sharpe ratio, this is sort of the drawdown you can expect. And I think that's a useful exercise for people to try and map between different kinds of risk measures. The second thing is a risk measure should reward consistency. So it's very easy to construct account curves that have very high Sharpes, but where, yes, all the returns made in a single month. So that's not really giving you any sort of statistical information about it, which is why I always try and use conditional things that look at the distribution, look at tails of distribution, things that are conditional, probabilistic, things that look at error bars around Sharpe ratios and things like that. And that will give you an indication of whether a strategy's just been lucky or whether there genuinely has been repeatable performance. And the third thing you should look for, and I've just added this to my list after what you said, is a good name. I think if anyone aspiring quant out there wants to come up with a good risk measure, then give it a catchy name and people will remember it clearly.
Yeah, no, that's true. Feel like questions now? I know you had more things you wanted to talk about, but maybe some of the questions. Let's do questions.
Yeah.
And so, funnily enough, the first question, which actually came in, and I apologize for the wait, Michael, it came in late December. But it's quite funny because Michael, who wrote the question, actually also commented on this particular blog post, and I think you agreed that he had made a couple of good points.
He's a smart guy.
To it. Yeah, smart guy. So Michael writes, so he talks about a question that he sent us last year, and he says, a follow-up question. Currently, I trade about 30 US futures instruments, equity indices, treasuries, energies, metals, ags, currencies. At what point does it make sense for a retail trader who trades once a day to go global? How much diversification does it provide? Having another foreign government bond or an equity index gives a little diversification, but not much. So the question is, how many truly diversifying instruments are there overseas, but not in the US? I know of a few, which is rubber, iron ore, but not that many. I'm a retail trader, so I only want liquid futures, no OTC stuff.
Back to the diversification question, which is, of course, one of my favorites. But it's a bit of a twist because I think most people tend to think about diversification initially across asset classes, and that's the best form of diversification. So if you're trading, say, an equity and a bond future, the best thing you can do is add an agricultural to that, add an FX market to that, and so on and so forth. Now, Michael's very lucky by trading US markets, and that just even by limiting himself just to US futures exchange, he's obviously got, there's hundreds probably of liquid markets he could be trading without going outside of, Chicago and New York. So he's very lucky there. And he's probably got access to, a wide variety of of asset classes, and also within asset classes, to within the commodities, he's got the softs, the liquids, and so on and so forth. So his portfolio already is very good, I would say. The thing he's missing is, as he says, the geographical diversification. So I would say this is going to be of less value than having the diversification across asset classes. But I would estimate, based on roughly what the correlation matrices look like, you might get an extra 10 to 15% of performance, by which I mean you would go from, say, an expected return of 15% to an expected return of 16.5%, 17%, with, say, a 25% vol target, by adding things like, the German bond futures, perhaps Australia and Korean bond futures. And then, you've got obviously all the equity indices. We've already mentioned the European V stocks, which is, a volatility market you can add, assuming you're already trading the US VIX market. So they will add a bit of extra performance. For me personally, if you can treat diversification as free, then, it's not costing you anything, then that extra 10 to 15% is worth having, right? Now, that's not always the case because, for example, you might have to pay data fees, to access these other markets potentially. The data fees in Europe are pretty reasonable, but I think in certainly for my broker, I think the Canadian and the Australian data fees were quite high. Just to access, 2 or 3 extra markets didn't really make it worth it. And the other issue, of course, is that as a smaller investor, I've talked about this a lot. You don't necessarily have the capital to diversify your markets, that much. So it may be that you really, as a retail investor, you've got a choice between trading. You've got a choice of about 30 markets you can trade. Now, whether those 30 markets are all in the US or whether they're spread across the world, as long as they're diversified across asset classes, it's probably slightly better to be across the world. As I said, it's maybe 10 to 15%, but it's not going to be a huge advantage. But if you were to say, be in a different situation and say, right, I'm going to confine myself only to markets traded in London, then that's a much narrower set of markets, and you get a much bigger bang for your buck by then diversifying to the European, the US, and potentially some Asian exchanges as well. The other thing, of course, you've got to consider when you go across countries is currency. So, you'll be expected to deposit margin in euros, potentially in pounds, in Australian dollars, in Korean won, and so on and so forth. And that's going to add a little bit of extra administration and friction to your kind of daily work, making sure you've got margin the right amount in these different currencies. And also that will introduce a little bit of currency risk into your portfolio as well, which you could try and hedge, but to be honest, for a small investor, it's probably not worth doing. The costs of hedging will exceed any benefits. So yeah, it's worth doing, but if it's not completely free, there's a little bit of extra work, probably. There's a bit of extra complication. And as I said, because he's already in the US with its wide variety of futures markets, he's not going to get a huge benefit from it. But, I would probably advise that it's worth at least considering.
Yeah, I mean, I would add to that is that if you just think about it, there's a couple of things that spring to mind where I think there could be some benefits and diversification. One is in London, you have a lot of base metals that you don't really get in the US. So I think those markets could be interesting from a diversification point of view. And I think even so we've been used to economies in the last 20 years becoming much more synchronized, and therefore you could say, yeah, but interest rates and stocks, they tend to be highly correlated. But I just have a sneaky feeling that as this unusual period continues, and maybe now with the UK outside of Europe, you've certainly seen Japan. I mean, the Nikkei has had a very different path than many other equity indices. I actually think that maybe the diversification benefit of having some European exposure and some Australia could be one, but also I think Japan actually, those markets are interesting. I'm not necessarily too keen on things like China and stuff like that. And of course, even though, we have a good friend who talks a lot about Chinese commodities, that's just not really an option for most people, not even for firms. So, but I do think there could be something worth there. And actually these markets obviously can be traded on the same platform with the same broker. So it's not like you need to do a lot of work. Maybe with LME markets are a little bit different because as far as I know, it's not really a true futures contract, but it is becoming more standardized anyway. So And I know one of our listeners who work at the LME really wants more CTAs to trade there. So maybe they are making it easier for us to look at it as a pure future. So great question, Michael, and thanks for your contribution. That always is interesting. Next question is from Bruno. Bruno, he says, I was looking at my IB year-end performance and it shows that I lost 0.27% on my cash. As a futures trader, do you have any advice as to where to put the extra cash that is not being used on any positions? I called Interactive Brokers and they said they didn't offer any specific solutions for futures traders in that regard. Any advice would be greatly appreciated. Maybe a solution for those that don't use a prime broker could be discussed on the podcast.
This is actually very interesting because in terms of timing, I was thinking about this myself only a few days ago.
Okay.
So my main trading account has always been a mixture of kind of long positions, which I've hedged, plus futures positions. And I decided to kind of simplify my life, and there were timing issues with doing this because of tax implications. But I've now kind of gone to a very simple portfolio. I've just got a big account full of cash, and then I trade futures positions, and that will use some of that cash for margin. But as Bruno says, there will be a lot left over, and depending on your vol target, most futures traders probably only use somewhere between 15 and 35%, maybe 50% of the push of their available capital as margin. So there's a lot left over. And there's a couple of implications of that. One is that potentially, well, you're not going to be earning any interest on it, are you, nowadays? And you may even be paying for the privilege of having the broker hold your cash. And the other issue is a counterparty exposure issue. So depending on exactly where you are and what kind of trader you're classified as. For me personally, the first £85,000 of that cash is, I believe, is insured by the government effectively, but everything else is uninsured. And if something happens to my broker, which touch wood it won't, that would potentially be money at risk. So it's kind of like, well, what do you do with this extra money? The insured difference between the insured cash and the cash you need for margin. I did have a look. There's a few things you can do. So one thing you can do is say, well, I'm going to use that cash to buy an ETF, which will be essentially a kind of money market like instrument. So it's going to be something that's going to probably give me very low returns, but it will be my counterparty risk has now changed from the broker to the ETF issue, which is probably a bit safer. And I was looking at a couple of options for this. So one was based on a total return swap of Sonia, which is the overnight sterling rate. So it's very, very similar to a money market instrument. That deals with your counterparty risk, but does nothing for the returns, because you're having to pay the ETF fee and probably potentially then being exposed also to what is now a negative overnight interest rate, or at least very close to zero. So you end up, for me, I was looking at it was going to cost something like 10 to 15 basis points a year. So one attitude is to say, well, that's basically I'm paying that's the cost of an insurance policy against my cash being taken away from me by my broker. So you may think that 15 basis points a year it's like buying a credit default swap on my broker. Maybe that's a reasonable rate to pay. I don't know. The other thing I looked at that was a bit risky was to invest in another ETF that had very short-term exposure to corporate debt, to commercial paper, basically, that kind of thing. And the good news is that had a positive yield, a very low one. Admittedly, you're talking about tens of basis points a year, but it was still a positive yield. In terms of risk, obviously there is counterparty risk, but it was, the duration is, a couple of days. So it's very unlikely that all of these big companies will go bust at once. And interestingly, if you looked at the price of that ETF, it's basically a very shallow straight line going upwards. And then in March, it dips down very dramatically because obviously everyone then is panicking and, and the thing sold off below the NAV value, but then it returned to this very nice curve upwards. So that's a slightly riskier way of getting around this issue and picking up a little bit more yield, but opening yourself up to slightly more risk. The other thing to mention for IB customers, and I don't know whether this applies to Bruno, but I think this is a US program only, but I got an email literally a couple of days ago saying that they're going to start a cash sweeping facility, which basically means they would automatically sweep your cash into a government insured account on a regular basis. And I haven't really looked into that. And I don't know whether that's a US thing only, because it did talk about FDIC insurance, which obviously wouldn't apply to non-US customers. But that's another option. But the short answer is, Niels, is there are no easy answers. We live in a world where cash yields nothing, and you can either suck that up and live with it, and potentially even have to pay a small amount to insure yourself effectively, or you can try and run your account at very, very efficient levels of cash, which has its own risks potentially. Or you can take a bit of risk and park it in something that's going to give you a bit more yield, but potentially opens you up to some counterparty risk.
I mean, being Danish, I follow the Danish markets.
Negative interest rates to you are just normal, right?
We have probably some of the worst negative interest rates on everything pretty much nowadays. I think you're down to, in many banks, anything above £10,000 equivalent, or maybe £15,000 equivalent, you pay now negative interest rates. So one thing I just want to make clear is that there are sometimes you just can't fight. Where you have to accept that that's the way it is, because anything you do to change it will put on a certain amount of risk. And so it's either you keep it safe and you pay, or you take a risk and you might, save a little bit. But I do want to remind people that in 2018, at least, fourth quarter, and where we saw the Powell pivot in December, I think a lot of that was actually not so much the equity markets that were falling, but it was just the freezing of the US corporate debt market, meaning also during the financial crisis in 2008, even some of these quote-unquote safe cash management funds, or whatever they call them over there, they got into trouble. And that was not a nice situation to be in. Even I think a lot of managers, CTAs, who were using at the time these quote-unquote money market funds to just push the cash that we sit with into an easy way of managing that, it became a problem. And I know on our side, it really was a big wake-up moment, and we decided to completely change how we manage the cash portion in our funds to keep them first and foremost safe, and not to try and speculate in terms of getting a slightly better return or anything like that. So, but we do use a cash manager in order to implement something like that. But it's a problem we all have in the world we live in. But I just want to kind of also, I think what Rob was saying, don't be too clever. It's better to pay 27 basis points per year than to lose 10% or 15% of your capital because something goes wrong. Okay, let's move on because I know we all have time limits today. Kyle writes in, my question is about scaling into and out of positions in trend following systems. Do you employ or believe there is an advantage to base a position size on the strength, the magnitude of the trend signal, or not just its binary value? For example, not just taking a position when a signal is generated by increasing the size as the signal stays positive and or grows in strength up to a predefined risk limit, of course. I would be interested to hear your thoughts and any research that you've done or come across that covers this topic. Now, I'm gonna start on this one, Rob, so you can catch up on the question. I know you had just had to pop out for a couple of seconds. So essentially, Kyle, I think that most trend following systems, because we don't just look at one time frame, most systems are really not binary, meaning we're either fully long or fully short or neutral. So you could think about it as long as you introduce different, and it could be time frame. So you could have to make it very basic, if you have a system that uses breakout based on 50-day highs or 60-day highs or 70 days high, whatever the number is, by having several of them, you could say that the stronger the trend becomes, the more it's going to break out of these time frames. And so you're scaling into your system, and vice versa, you're going to be scaling out. So this can be done in so many different ways. But I do think that it makes sense not to put all of your eggs in one basket, meaning only trading one time frame. But I want to caveat it a little bit, because I think if you, and this, of course, we don't really would touch on this in terms of the diversification you get from trading different markets, because that's important as well. But if you just look at the time frame issue, in some periods, of course, getting in with your full position size in one go can be a big advantage, because if the market just goes and doesn't look back, then you could say you get your full exposure straight away. So I'm not saying necessarily that you're going to get better performance by scaling in and scaling out. But what I'm saying is that you're more likely not going to suffer as big drawdowns as you would otherwise do, because when you use very few time frames, only one time frame, so you're really binary in your position size, when markets, which they tend to do, unfortunately, go through these range trading periods, which can last for years, frankly, in some markets, you're going to lose a lot of money by being stopped in and stopped out several times in a row. So I think as much of it as you could say it has a performance-related aspect of it, it certainly also has a risk aspect, in my opinion. So I hope you had time to get this, the sense of the question, Rob?
Yeah, absolutely. So there's two ways that scaling in and out behavior kind of would appear. One is through, as Niels says, a time-based diversification of systems. So that means if you imagine a trend's just starting, then your faster systems will be in there first, and then your medium speed systems, and then if the trend continues long enough, your slower systems as well, and then you'll have a full position. So from an outside perspective, if you don't know what's going on inside the black box, it will look like you're gradually adding a position as the trend increases. But what's actually happening is that you've got separate independent systems behaving separately, producing this kind of behavior. The other thing that can produce is if you use something based on a forecast, a strength of trend, to change the size of your position. So let's abstract it down to just a single system that has just got one time frame. Then basically that will do something similar, which is as the trend gets stronger and builds, it will increase its size of its position up to a certain point. And I have actually done quite a bit of research on this, and there's a couple of blog posts on my blog about this, and that there is quite a clear pattern that basically the stronger a trend is, the more profitable your future expected return will be. And that means you should actually scale in to the position as the strength of trend grows. So that will produce, for your individual speed, that will produce a kind of adding behavior. And then if you overlay that with, as Niels says, the additional diversification across time frames, that will also produce an adding in behavior. So you'll get that kind of behavior. And both of those things definitely work in the sense that they add money, profits. So I think roughly 20-25% improvement in returns from going from a binary system where you just buy when the trend turns in your favor versus one where you're building as the forecast changes. And you can also get something like a 15% improvement in returns from diversifying across different time frames. And as Niels says, it's also very much about giving you more consistent returns in your back test and going forward, because if you have something like March where the market sells off very sharply and then goes up very quickly, if you have got a kind of all in or all out system, a difference of just a few days of when you make that decision to switch completely could make a massive difference to your returns, and could easily, for example, for 2020, have moved you from a profit to a loss just by basically what is bad luck. Whereas if you've got a diversification across timeframes and you've got something where you're scaling in and out more gradually of your position rather than just going in one go for a given time frame, then that makes it less likely you'll be exposed to this kind of idiosyncratic return risk on just a few days.
Yeah, no, I think you're spot on there, Rob. And I think actually 2020 was one of those years where there was huge difference. I mean, you could have been a trend follower and lost your shirt.
Yeah.
And you could have been a trend follower and made a bundle of money just by having the right or the wrong time frame. So yeah, generally I don't recommend just sticking to one time frame. For sure. Let me jump to the final question for today, because I know we have a hard stop today. So this question is from Craig. Nice to hear from you, Craig. I had a small question for the podcast. You may have answered this before, so apologize if you have. I've noticed that we are increasingly living in a world of an aversion to risk, or I might even go as far as saying phobia of risk. And this has been noticeable socially, politically, and in investing with the trend towards passive indexing. How can trend following take advantage of this environment? That's a good question, actually.
It is a good question, although I would slightly disagree with the fact that there's been aversion to risk in investing, because there's, we were talked about value and growth, at the start of the podcast, but if you look just at kind of average multiples in say US equities, they're pretty high. I mean, people are talking about bubbles just generally, but also in individual stocks like Tesla, which of course has gone up a lot recently and made Elon Musk the richest man in the world, as we're all aware of. So I'm not completely sure I'd buy the idea that people are, in a sort of strict valuation sense, becoming more averse to risk. Certainly in March last year they were, because obviously there was a big sell-off and the valuation multiples changed. Now actually the multiples, particularly in the US, less so in Europe and certainly in the UK, look quite stretched. But I guess trend followers can benefit if trends happen. So if people become, for a series of years, either more risk averse, which would produce a sell-off in assets, then obviously, that would be a nice clear trend we could pick up on. If on the other hand, people become, less risk averse and prices rise, then obviously that would be a clear trend. That's a kind of sort of trite answer, if you like. I guess more generally, that if people do really genuinely become less averse, more averse to risk, then what they ought to really be thinking about is diversifying their portfolios to different sources of risk. Because, if you're worried about the equity markets, but yet you've got all of your money in the equity markets, well, that doesn't make any sense, right? You should really be diversifying into something else. Into what, though? Bonds? I mean, as we've discussed, bonds and other kind of interest rate instruments don't look great. You can still make money from carry probably, but you're unlikely to make money from interest rates going down a long way from here. So, other strategies, things like trend following, that's really where people ought to be thinking about putting their money. Whether they will or not, I don't know, because, if people perceive those as risky, if as trend following as risky, despite our best efforts to educate them otherwise on this podcast, then obviously they'll stay away from it. But really, that's what people should be thinking.
Rob, before Christmas, I think I put forward this thing about that we talk about, a safe storage of wealth, or whatever they call it when they talk about Bitcoin and gold. That and I put forward, said actually I think the safest would be a diversified trend following strategy. That's actually how you should store your wealth. And I know Jerry was jumping for joy and tweeting about it. So I'm all with you there, and we'll continue to fight the good fight. But going back to the question, I actually disagree a little bit, because I actually do know what. I say I know. I think I know what Craig means when he says that there's this risk aversion, because I sense it as well. I sense that people want the safe stuff. They still expect the high returns, but they kind of don't like anything that can give them big drawdowns, which is also why trend following has not really been a favorite strategy. It's been all this, relative that kind of strategy. So I do sense what Craig is saying, but I think the answer is this, Craig, and that is, I don't know that trend following can do anything different to take advantage of it, because the truth is, people change their opinion as to what is safe and what is not. It has been long perceived, for example, that bonds is the safest thing you can buy. I'm not so sure that it's going to stay that way. It seems to me right now we're going through this phase where actually equities could be what people see as safe, because it's not governments directly. I mean, it could be influenced by governments, but you're owning a piece of a business. But if you own a government bond, and with all they're doing now with their printing press and MMT and whatever we know is going to happen or we don't know, but whatever we think is going to happen now with the new president and with the two houses in the US going in one direction, what that could mean in terms of more stimulus, I could see that it's going to be the bonds that people are going to feel and experience as the most risky part of their portfolio. So when you think about the 60-40 portfolio, and it will be different from country to country. I mean, in Europe, often you actually have 80% bonds and 20% equities being what people think is the best portfolio. I think these portfolios are going to change. And what I really hope is that people will be brave enough and actually replace the bond part with trend following, diversified trend following, because one, people shouldn't expect a positive return on their bond allocation when you look at negative rates in Europe or zero rates in most places. How can you even expect a positive return on that if you keep it to maturity? You can't. But with trend following, I think, again, we as we talked about earlier, we've shown that we can make money in many different environments. By the way, 2020 was a good year for trend following as it turned out. But this comes on the back of another really good year in 2019. So it still strikes me as being interesting, to say the least, that people prefer to talk about trend following not working and being dead. I mean, where's the evidence of that? So I like your question, Craig. I think people should think differently, though, about what they feel is safe. And so when they think risk aversion, maybe diversified trend following would be a great combination with, say, a stock portfolio. We know for sure on the data we run on our side in when I do my day job, that if you put 50% S&P or 50% MSCI with a 50% allocation to what we do, you don't even get a return that is somewhere in between what we have delivered in trend and what you would have gotten in equities. You get a higher return of both return streams because of the non-correlation. That's the argument. That's what people need to focus on. Of course, you get lower lower drawdowns, you get lower volatility, but your actual returns when you combine things that are uncorrelated actually goes even higher than any of the two components. That's the secret. Okay, let's quickly move on to tell you how the year kicked off for the industry before we wrap up. Beta 50 index, which finished up about 5% last year, is up 1.46% as of Thursday night. SocGen CTA index finished up 3.14% for 2020, and it's up just shy of 1% so far this year. The SocGen Trend Index is up almost 2% so far this year, and it finished up 6.25% last year. The Short-Term Traders Index is flat this week, and it finished up 3% in 2020. And MSCI had a good start to the year, up 2.25% more or less, 2.35. But world government bonds lost 60 basis points this year, which is actually quite a bit in a week for the bond index. I'm not going to ask you today if you have any good resource to suggest, but feel free to answer, because I don't have any suggestion myself. It's just no time for me to listen to many podcasts this week with year end and month end.
Well, very quickly. So I'm going to mention three things. One is directly related.
Oh, you did? Okay, yeah. Cool. You do have some. Okay, cool.
One is related directly to finance. One is a bit tangential, and the other is completely unrelated but interesting.
Fantastic.
So I'm a big fan of Matt Levine, who works for Bloomberg and writes this daily newsletter called Money Stuff, which is very, very interesting. And he's just actually restarted writing that after taking, I think he was on paternity leave for a few months. So if you don't already subscribe to that, I highly recommend it. The sort of vaguely related to finance thing is a podcast I listened to recently by the guys at The Ringer. It's about gamblers. It's literally called Gamblers. And of course, gambling and finance and trading have some overlaps, and that's a very, very interesting listen. If you, like me, you're interested in gambling as well as in finance. And the third thing is a podcast from the BBC from a guy called Tim Harford, who also writes for the FT, and his main podcast is something called More or Less, which is about sort of statistics and things in the news. And he, over the pandemic, for example, he's done a lot of analysis of the coronavirus statistics, and it's been very interesting. But he's got a new podcast now, actually, which is about vaccines, and it's very, very good. And he's been interviewing people like Bill Gates, for example, and talking to people who are experts in the vaccines, because the job of inoculating potentially billions of people over potentially the next few months even, or certainly the next year or so, is something that's never been done before. So the logistics and the science and all that behind that is very, very interesting and very topical. So I'd recommend that as well.
Three interesting recommendations that I never come across before, and of course, someone in interviewing Bill Gates, that in itself is controversial because you never know what side he really is on. I guess if you listen to the conspiracy theories. So yes, absolutely, I appreciate that. And of course, make sure you keep sending questions to us. I know there are questions we didn't talk about today, but that's because in those questions, they were more minded for Moritz specifically. There are a couple of questions for him. So we do love to give you our views on your questions. So keep them coming to info@toptradersunplugged.com. Rob will be back in 4 weeks. Moritz will be on next week. Jerry will be on in 2 weeks. And our new secret co-host, by the way, is going to be Mark Resentsinski, who were on only a few weeks ago, and he will be also rotating every 4 weeks, and maybe sometimes we're going to do some joint ones together. We'll do as much as we can, and I'm sure we'll also have some fantastic guests on along the way, and so on and so forth. So hopefully lots of good things to come in 2021 for you. If you want to support us, please leave a rating and review in iTunes. They mean a lot for a show like ours. And of course, check out Rob's blog and all the stuff and great content that he produces. From Rob and me, thanks so much for being with us today. We look forward to being back with you next week. And in the meantime, be well, stay safe, and take care.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.